Hello traders. So as you've seen from the title of this video, I believe that many traders are losing money in the markets because they are trading with the lower time frames. We've all done it. We've all gone on to the 1 minute time frame. We've seen how quickly price moves and we want to make profits. But is that the best way to trade long term? Is that the best way to guarantee your trading success? The answer is no. Don't get me wrong. There are people who are successful on every time frame. You know, it could be the 1 minute time frame or the 8 hour time frame or even the weekly time frame. It doesn't really matter what time frame, but for the majority of people that would be watching this video in the retail space and relatively new to trading based on the demographic that I usually attract to these videos, you will be tempted to trade the lower time frame. I was tempted when I started trading too, and it's something that not many new traders can actually avoid. So the main reason behind this is psychology. People would say, oh, it's a lower time frame, so I get more setups. But that's obviously the simple way of putting it. But if you think about what's happening in your brain when you're seeing price move and a new candle is open every minute, you see unlimited setups. You see so much volatility just by watching the price movement on the 1 minute time frame. Your adrenaline has spiked. And this is what we want to avoid in your trading. We don't want to have massive spikes of adrenaline. We want to trade with a level head and go into the markets and trade our plan just as we did in our testing. But when you're actually going on to the 1 minute time frame, you see chaos. And when I say chaos, I literally mean chaos, especially if you are trading a volatile pair, let's say gold, for example, or GBP USD. Those pairs are especially volatile, and you'll see just crazy movements. And people trade it because they can make a lot of money very quickly, but they don't realize that they can also lose money very, very quickly. Majority of the time when people are trading on the lower time frames, they're trading with very tight stop losses. So on gold, it could be 5 pips or 10 pips even, and that is relatively small for gold. If you're trading Euro USD or GBP USD, your lot sizes could be as small as 2 pips, 2 pips, 3 pips. I've seen some people even use half a pip or 1 pip stop loss. And is this really a good way of going about your trading? I don't think so. Just take into consideration if you're using a 2 pip stop loss, and let's say price goes up 1 pip. 1 pip is tiny, and you're already halfway to your stop loss. And imagine the commission on that trade for 2 pips. So majority of brokers charge per lot commission. So you'll get $5 per lot, for example. So if you're trading with a prop firm challenge or a funded account, for example, which is a large account with a 2 pip stop loss on a $200,000 account, you're trading with 100 lots. So 100 lots is obviously, if you do the $4.50 times by 100, you're getting $450 of commission for that one trade. So instead of losing $2,000, you're now losing basically $2,500 if you get tagged out of that trade for a stop loss at -1% or a 2 pip loss. So instead of $2,000, you're now losing $2,500. So then you have to take into account, okay, I now have to lower my lot size so I'm still losing 1%. But that will also make your win smaller. So although you're making quick profits if you are winning, you're also making less profit because you're having to lower your lot size because of the large commission if you do end up losing. Because if you lose 1.25% every time you lose, over 4 trades, instead of 4% loss, you've lost 5%. So on a prop firm challenge, if you're only allowed to lose 10%, you can only lose 8 trades instead of the 10 trades. So it kind of limits you from that sort of funded account perspective. And I do feel like people go on the lower time frames because they see setups all day, every day. And this is kind of the habit that I feel like people need to remove from their mind when they are going into the markets. You don't need to see a setup every single day. If you saw my trades taken last year, it was very, very few, probably, less than 60 trades. So probably around 1 or 2 per week, for example. And if I was trading on the 1 minute time frame, I would see multiple setups every single day. And this can be a good thing. If you are a good trader, you have a high win rate, you're making loads of profits. But the way I always think about it, and I've thought about this from the start, let's say I'm taking 2 trades per day, which is a possible 60 trades in a month. And that isn't even hyperbole. I've seen traders take 5, 6, 7, 8, 10, 20 trades per day. But the way I think of it is, if I'm taking 60 trades in a month, obviously I'm not going to lose every single one of those trades, But what happens if I actually do lose every single one of those trades? I'd then be down 60% of my account, which is ridiculous. And let's say I lost 50 trades and I was down 50%. To make back 50%, I now need to make 100%. So people that are trading so much, like taking lots of trades, quick trades here and there, firstly, like I mentioned before, your commissions are increasing. And secondly, you're risking so much of your account per month or per week or per year that you could potentially go into drawdown. Would you want that drawdown? Most likely not. And people don't realize that if you go into 50% drawdown, obviously that's an extreme example, 50%, someone doesn't usually lose 50% in a month. But for this example, let's say 50%, because it's an easy number to use, you then need to make 100% back. Because obviously if you're risking 1% of the 50% balance or 50% of the original balance, you then need to make 100%. When I started trading, I was trading the 1 minute and the 5 minute timeframes, and I was trading them on gold. I did a lot of account flips, so it's very easy for me to go, okay, here's a £10 account or a £25 account. I can flip it to £300 in a day. But the amount of time that worked in comparison to how many times it failed and I blew the £10 in 3 candles, you know, it doesn't really make sense to actually do. And this is what I see people doing. They think, oh, I need to quickly pass this prop firm, let me go down a time frame. But in reality, what you should be doing is, if you want to have a higher chance of passing a prop firm, go on the higher time frames, because there's so much less confusion on the higher time frames, and you can have more conviction in entering your trades and risking part of your drawdown allowance on each particular trade. So obviously I've said the downsides of trading with the lower time frames. So now I'm going to give you the positives of trading with the higher time frames. And we're going to start with a very simple one, which is you'll take less trades, and this allows you to be more selective with the trades you are taking. The main reason why taking less trades is a positive. We obviously have what I mentioned with the lower drawdown. So over the month, over the year, you will have a lower drawdown as long as you keep that high win percentage. But also you can focus more on each individual setup. If you're trading 5 to 10 setups per day, we're just going to use that as an example, you then have to go through your checklist. You then have to evaluate that setup. You have to journal that setup. That's what I do per trade. And if you're doing that 5 to 10 times per day, and let's say you hit a losing streak, that can be quite emotionally draining. And it can also be draining on your account, which isn't great too. But you're not able to fully commit to a trade if it's happening 10 times a day. People will say, oh, well, I'm getting used to the setup because I see it so often. But also, you can't have full conviction if you have 1 minute or 2 minutes to react to a setup. When I'm trading on the 4-hour time frame, I usually have at least 4, 8, 12, 16 hours to journal the trade, do all the analysis, set my limit, and be ready for the trade to tag me into the position. So I can focus and see exactly what's happening in the markets at that time. I can check if there's news coming out. I can check absolutely everything to make sure that setup is an A+ setup for my strategy. Whereas on the lower time frames, I just don't think that's possible. And also you can have a lot larger stop loss sizes. So when I was trading on the 1 minute or the 5 minute time frame, my stop loss sizes would be, 5 pips or most of the time less than 10 pips. And if you go on the higher time frames and see this, you could have 5 trades on the 1 minute time frame in a small wick on the hour or the 4-hour time frame. So what's happening for you on the lower time frames doesn't really matter. It literally doesn't matter. So in the overall market trend, you're just caught up in these tiny little moves or these tiny wicks that are taking you out of the market. And if you are increasing your stop loss size, granted your risk to reward will suffer, but because you're on a higher time frame, your target will also be larger. So your target will be larger, your stop loss will be larger, and as long as you maintain a decent win rate, you can then also make more profit or even make the same amount of profit and be more selective for the setups you are taking. I also think it helps with revenge trading. Revenge trading on the 1 minute time frame and the 5 minute time frame can be brutal. I was victim to this in the past, and I see many people are victim to this still. One thing that can show you if someone is trading the lower time frames successfully or not, just ask them to show you their trade history. And if you see they're trying to sell GU and then they try and sell it again, that is not a good sign. There could be that many valid setups in a row, but is that very likely? Most likely not. If there's been that many valid setups and it's lost so many times in a row, why would they still be trying? Doesn't really make sense. So revenge trading is very, very hard on the higher time frames, but it's very easy on the lower time frames. If I've waited 12 hours for a setup, I get in the trade and then it loses, I know that I was wrong. My stop loss is above or below a previous high or low, a significant point in the markets. So if I was wrong, then I've got my complete direction wrong and the market is changing direction. Whereas on the lower time frame, price can pretty much stop you out 5 times in a row and still go against you, but then reverse, and then you try and get in again. But on the higher time frame, that doesn't happen. You don't get the situations that actually allow you to revenge trade if you are trading them properly. And I also feel like it gives me a clearer vision. So when I go on the charts, I can see exactly what's happening. I can see what's happened the past few days, the past week, and I can see where price is most likely looking to go. And you can't do this on the lower time frames. You could be distracted, the doorbell could ring, your dog could start barking, your child could need your attention, your Wi-Fi could go down, and you could miss 1, 2, 3 setups. You can miss your 1 good trade for the day, or your 2 or 3 good trades for the week, just from a small minor inconvenience. Whereas with the higher time frames, I have hours to prepare for a setup. I can set limits. I can be completely ready if there is anything happening in my life. So it's very hard to miss a trade on the higher time frames, and this also leads to a reduction in your stress levels. You don't have to constantly be fixated on the charts for hours and hours every single day to ensure you don't miss a setup. I can set alerts, I can set limits, and be completely prepared, which is something you can't do on the lower time frames. And the final point is it gives you a clear picture of the trend. I see people trying to trade the 1 minute on their phone. They're zoomed in, looking to trade each individual candle, but obviously they fail. But if you've got a computer, you have a big screen, you've zoomed out, you're on a high time frame, you can see everything that's going on. You can see if there is a break of structure, you can see if there's a bullish trend, you can see if there's a bearish trend, you can see if there's going to be a reversal. But you can't do that zoomed in on the lower time frames. You can only see the past 30 minutes. There are going to be people commenting, I'm successful, I trade the 1 minute time frame, or this trader I follow trades the 5 minute time frame, or the 30-second time frame I've even seen. I'm not saying every single person trading the lower time frame can't be profitable, but I'm saying for the vast majority of traders watching this video, you're better off trading the higher time frame and focusing on that. So if this video did help you, be sure to like and subscribe, and I'll catch you guys in the next one.